And welcome back to another Econ podcast with Mr. Hagan. On this Econ podcast, we're going to start to talk about different types of retirement accounts. I first want to be clear that this video is not designed to give investment advice or tax advice. Its purpose is educational only. This videos and other videos in this playlist are designed to teach about different retirement accounts. If you want investment advice or tax advice, please see a professional. All right, so let's talk about the different type of retirement accounts that are available to people who are investing and putting money aside for retirement. So first of all, I'm actually going to talk about non-retirement accounts so that we can then contrast non-retirement accounts with retirement accounts. So I'm going to start with what I'm going to call a personal account. Okay, so I'm going to start with what I call a personal account. So a personal account is money that is not going into a retirement account. It's not going into any kind of qualified tax advantage savings program. Okay, this is just kind of normal saving that somebody might do. Not quite normal saving. I'm not talking about putting money in a bank, but investing money, say, in mutual fund companies that's not intended for retirement purposes. You're just kind of investing some money and hoping that you make some money. So that's called a personal account. Now here are the rules with personal accounts. If you put money into a personal account, so let's say you have, let's say you decide, I'm just going to pick a number. Let's say that you decide to put $10,000. Let's say you decide to put $10,000 into a stock account with Vanguard Mutual Funds, in a Vanguard Mutual Fund. Okay, so you put $10,000 in that account. What I want to deal with in this video is how is that treated by the government? What are the rules with the tax man with that money? So this is not in any type of retirement account. You just put $10,000, let's say, in the S&P 500 index of Vanguard. And so how's that money going to get treated? Well, first of all, there are no tax deductions on those contributions. This money that you put in is called the contribution. You contributed $10,000 to this Vanguard account. There's no tax deduction. And you might say, well, okay, no kidding. Why should there be a tax deduction? But we're going to see that the tax deductions are going to matter for retirement accounts. But right now, in a personal account, no tax deduction. Number two, unlimited contributions. You can put as much money into this account as you want to. You could put in 3,000, you could put in 3 million. It's completely up to you. And again, you would say, well, of course, why wouldn't it be up to me? And it is up to you. You can put as much in as you want. The money's going to grow at the after-tax total return. Now, I'm going to talk about the math of this a little bit here in a few minutes. But after-tax total return, the ATTR, that just means that not all of your earnings from this are going to get reinvested. Some money is going to have to come out from your dividends and capital gains in order to pay the tax man. And I talk a lot about this in my investment playlist, so you might want to check that out. And then the money, when you withdraw the money, you can take it out anytime you want. And again, you would say, well, no kidding, it's my money. Of course I can take it out anytime I want. And that is true for personal accounts. And you can invest that money in any stock or mutual fund that you wanted to. That we chose the Vanguard S&P 500, but you could put that in any mutual fund, any stock that you wanted if it's a personal account. There's no limitations on this. Now, as I talk about some of these rules, I want you to remember that I'm creating this video in 2020. I'm creating this video in May of 2020. So keep in mind, a lot of the rules that I talk about on the videos in this playlist, they're going to change as time goes by. So my goal here is to teach general principles of retirement accounts. The specific rules are going to change over time, that's for sure. All right, so let's do the math behind this. How would we calculate this? Well, the first step in calculating how much money we will accumulate over some time period, step number one is we have to calculate the after-tax total return. Now I'm going to do an example of this. You have to calculate the after-tax total return. And that's calculated by taking the total return, the amount of percent that you're earning each year times 1 minus your investment tax rate. I just have tax rate here. I should probably have investment tax rate. So there we go. I just paused and fixed that here so that I'm being really clear. You take the total return, the percent that you're earning, times 1 minus the investment tax rate. Tax rate was correct. I just want to be more specific because there's a lot of different tax rates. This would be your investment tax rate, and the investment tax rate would include things like the dividend tax rate or the capital gains tax rate. Both of those things I talked about in the investment playlist. All right, so the after-tax total return is the total return times 1 minus the investment tax rate. And then step number 2 is you take that ATTR and you just plug it into the formula, P times 1 plus R to the T. But your R here now, your return each year is going to be the after-tax total return. Okay, so these are going to be the important steps, mathematical steps that we're going to follow. Now, you might say, well, I don't understand all of this. What's all this mean? So let me do an example with some actual numbers so that you understand what this means. So here comes my example. Let's say that we have the following situation. Let's say that somebody puts $10,000, that was here, in the S&P 500 index fund at Vanguard. Let's say that that investment is earning $10,000. Your contribution was $10,000. Let's say that you have a total return of 10% per year. You earn 10% per year on that money. And let's say that the investment tax rate on your capital gains and dividends is 15%. And you're going to withdraw the money in 30 years. So how do I put that into these different steps and calculate how much money this 10,000 will turn into at the end of 30 years? How do I do that calculation? So here we go. Step number 1. Step number 1 is I calculate the ATTR. So let's see, the after-tax total return, the ATTR, the after-tax total return, is going to be 1 minus the investment tax rate, which is 15%. I'm going to write that as 0.15. Sorry. Let me back this up. I just made a mistake here. The after-tax total return equals the total return. There we go. Now we got it right. Is equal to the total return times 1 minus the investment tax rate, which was 0.15. That's your 15% investment tax rate on your capital gains and dividends. Okay, so that means that the after-tax total return is equal to, well, the total return is 10%. I'm not going to bother writing that as a decimal. You could. I'm just going to keep that as 10%. Times 1 minus 0.15, which is 0.85. So what this really means, what this number, this 0.85 means is I'm going to keep each year 85% of my 10% return. Why am I keeping 85% of my 10% return? I'm keeping 85% of that because the government is taking the other 15%. Okay, the government's taking the other 15%. So that's equal to an after-tax total return. That's going to give me my after-tax total return is going to be equal to 8.5%. Okay, so just look, just to be really clear about things, I took right here, I took the investment tax rate and I wrote that as a decimal. And then my total return, that's right here, my total return, which is 10%. I did not bother writing that as a decimal. Okay, no big deal. You could, if you did that, you would have got an answer down here of 0.085. You could do it either way. Doesn't matter. I'm just kind of avoiding the decimals there. Okay, so we end up with an 8.5% after-tax total return. So instead of earning 10% per year, I'm only going to earn 8.5% per year because the other 1.5% is going to go to the government. I have to pay taxes every year on my dividends and capital gains. All right, now step number 2. Step number 2 is I use this and plug it into my formula. So I'm going to get P times 1 plus my after-tax total return. That's going to be my 8.5%. raised to the number of years that I invest the money. So the amount of money, my P, the amount of money is going to be $10,000 times 1 plus 8.5%. Now I do have to turn that into a decimal. So it's going to be 1.085 raised to the number of years, which is going to be 30. Which is going to be 30 years that I'm putting this money in there. So that $10,000 that I invested in the S&P 500, I get 8.5% return on that per year. So I multiply that by 1.085. I invested it for 30 years, let it there for 30 years, and then I get an answer at the end of 30 years. I will have $115,582.52. I just rounded that up, and 52 cents. Okay, and I should have that number down here. You guys can't quite read it. Let me just move that up. Doesn't really matter, but there we go. Just move that up a little bit. There's the $115,582.52. That's just this number over here. And so that's the amount of money that I will end up with at the end of 30 years if I put the money into a personal account. Okay, if we put that money into a personal account. Now, we're going to look at some other examples of this with other types of, if we put this into retirement accounts. Instead of putting it into a personal account, what if I put this into a retirement account? How does that change my final number? We'll talk about that on some future videos. All right, this has been Mr. Hagan on another Econ podcast. Thanks for joining me, and we'll see you on the next Econ podcast.